Welcome to another Ronel Talks Money show. Now remember to please subscribe to the channel. There's also a link at the bottom in the description where you can also enter our monthly giveaway competition where you can win one of my books, Financially Fit and Wealthy, some online courses and various other prizes. So please subscribe to the channel and enter the competition in the link at the bottom. Now, today we are going to discuss balanced funds. And many of you probably are already invested in a balanced fund, or maybe your pension fund assets are invested in balanced funds. So the purpose is to learn more about balanced funds, and also if you are not yet having an investment, for you to learn and to see if it is maybe something that you should consider adding to your investment portfolio. Now today we have Johan Louwrens with us to help us digging deeper into balanced funds. Now Johan is a senior portfolio manager from Cadiz Asset Management, and Cadiz was established in 1996. They are a fund manager that manages fixed and income, multi-asset and equity funds on behalf of its institutional and individual clients. Johan, thank you for joining us and welcome.
Good morning, Ronel. Thank you so much for having me on the show. I'm very excited to be here. And, I just want to say it is actually great that you have this forum where you can educate people and kind of give them the information that they need to make more informed decisions, ask the right questions, etc. So thank you very much for having me on. I hope your viewers enjoy it and they find this very useful.
Thank you. So let us dig into it right from the start. Maybe you can start off by just explaining to us what a balanced fund is all about in layman's terms.
Okay, so obviously with regards to the collective investment scheme landscape, there's funds that you can invest in all the way through from low risk all the way to high risk. So what a balanced fund is, as the name would actually imply, it's kind of a really good balance between both extremes. And the reason it is like this is because it's predominantly built to give you a certain outcome, and that outcome is sort of in line with retirement saving, and I'm sure we'll discuss that a bit later. But ultimately, that balance fund, what it does is it uses various asset classes. So, for example, fixed income or your money market or equity, etc. It uses all these various building blocks to come out with a portfolio that hopefully reduces risk and performs to its benchmark at least. And ultimately, most balanced funds are benchmarked against a CPI plus outcome, meaning that you want to not only preserve your money with regards to inflation, you want to keep up with inflation, but you also want to grow your money. So that is really high level what a balanced fund is and kind of how it is constructed.
Okay, so a balanced fund is obviously one of the classes or the types of unit trusts. But maybe you can also just explain to us, how is it different from your other types of unit trusts?
So a very interesting aspect about balanced funds in particular. So this falls in the CISA category known as the South African multi-asset high equity space. And this, once again, is predominantly used for pre-retirement money. You can use it in other aspects, but predominantly it is used for pre-retirement. So this is really building up to retirement, and it's actually it conforms to certain rules with regards to the Pension Funds Act. So it's a very specific fund with a very specific purpose. And once again, those guidelines set out almost risk parameters so that you don't take on too much risk, so that you cannot lose too much money. I mean, there's always a possibility that you do lose money. That's a risk in investment, unfortunately. But because of those guidelines, it has to adhere to a very strict set of asset allocations, etc. So that really distinguishes this type of fund versus the other collective investment schemes.
Okay, what would you say, what are the pros and the cons of a balanced fund?
So that is actually a very good and a very difficult question, because some of the pros can also be seen as cons. So, if you look at a balanced fund, let's maybe just talk about equity in general. So a balanced fund can have a maximum of 75% allocated to equity. Okay. And once again, this falls within the guidelines that I mentioned in the earlier question. The reason it can't go to 100%, for example, is because that's seen as too risky. So, one of the pros is that it cannot take on too much excessive risk, for example. But if the market is doing exceptionally well, so if you see the JSE doing 20% for the year, you could only have 75% exposure to that. So that is a con, but also a pro with regards to excessive risk. Another pro is the fact that because these funds are very highly regulated and because they are trying to achieve a very specific outcome, a lot of the managers will manage the money to try and really reduce risk as much as possible through diversification. The fact that you have access to the various asset classes, whether it's fixed income or equity, etc. That is something that's missing in, for example, the equity space, where you pretty much have a limit on the least amount of equity you can have. So that would be 80%. And then the rest can be sitting in cash or cash-like instruments. But you're almost always fully invested. So there's obviously more risk within that. So like I say, the other pro is that you can use these various asset classes to get a very specific outcome while reducing your risk. And you can be very nimble in how you see the world evolving and actually then target those various asset classes. Once again, it can also be a con. If you do get your asset allocation incorrect, it can obviously hurt you. For example, let's just say very simply, fixed income has outperformed equity, but you predominantly invested in equity and cash, then you wouldn't have done as well as some of the other managers who had invested in a lot in fixed income. And like I said, if the fixed income outdoes equity, just from the dynamics of a portfolio, you're not going to do as well. But, as the name implies, it is really trying to give you a balanced outcome. So that, like I say, is probably one of the key pros of those funds.
Yeah, and I guess with the fact that not all asset managers will invest in the same equities, it also can vary from asset manager to asset manager. Maybe one asset manager invested in equities that didn't perform that well, but another asset manager invested in equities that actually performed well, and that fund is actually then performing better than another balanced fund in the market. Would that be true?
Oh, absolutely. One of the key factors, so, how managers look at this, generally speaking, is there are two kind of areas where you need to focus on. So your asset allocation call, getting it right, the equity, the fixed income, the property, etc., but also the selection within that space. Because as you rightfully point out, it's very easy to say, manager A and manager B have exactly the same asset allocation. It's not to say that they're going to perform the same. If manager A had gotten all his or her stock picks correct, then that fund is obviously going to outperform manager B, who may have made poor decisions, even though the asset allocation was the same and maybe the asset allocation was correct. What we do, however, see is that a lot of the performance is driven from your asset allocation. But it isn't the whole story. You are absolutely correct. But that makes it very difficult managing these funds. It can be very challenging at times. And, because it is versus a inflation plus benchmark usually, predominantly it's about CPI plus 4. Ultimately, what you want to do is you want to have a look at your asset allocation, and you obviously have a view on what those various assets are going to do. And you want to see what combination and weight of those assets is going to give me my specific outcome. And in our case, it is inflation plus 4%. And then you have to go look in your various little carve-outs, your little building blocks, let's say equity. And you go, what equity is going to give me that CPI plus 4 target? And that's ultimately how you want to build your portfolio, and obviously taking into account risk. That's the very important thing. How are these assets going to interact? How are the individual assets within those little buckets, how are they going to interact? And is that going to provide you with that risk-adjusted outcome that you are looking for? Because it's very easy to over-concentrate your portfolio and take undue risk. And that's when you're going down a very bad path where you can actually unintentionally hurt your end client. And that's obviously something we're very cognizant of. So we focus heavily on risk as well, risk mitigation.
Mm-hmm. And then you've mentioned now that the purpose is more like pre-retirement investing. And if you just think about the underlying assets in terms of equities, you would assume that it's more kind of a longer term investment. But can it work kind of on the shorter term as well?
So, I mean, the way we look at it, ultimately, if you want to look at a short-term period, it's probably 3 years, but really these investments are 5, 7, 10, 15-year investments. It's really something that you put your money in. And it's obviously very important that you do your homework with regards to the manager that you're actually investing in. That manager should resonate with you, and you need to understand their process and philosophy. And you need to understand that in this space, it is really a long-term investment. You obviously get situations where you see a fund doing exceptionally well over a very short period of time, but I would really caution against anyone who tries to time, getting into the correct fund at the correct time. Over a period, you might get it correct, but, if you switch between funds, etc., it's really difficult, and you can really hurt yourself in the longer term. So, like I say, it can do well in the short term, but really it is a vehicle for a really long term period.
Yeah, and I think that is also important for people to understand, not to kind of start investing into something and then within 6 months or whatever they see it's not performing as they expected, and then they disinvest, go into something else, to kind of just stick through a period. I mean, like we've all seen now, the markets were not doing very well, but you can already see that recovery phase. And I think it is sometimes just to have patience and wait for the fund to do what it is supposed to do.
No, absolutely. When it comes to investment, psychology is a huge part of what we do. And, we often try to engage with our clients and just explain there are going to be periods where things don't go well. And it might even happen that happens as you invest. Unfortunately, if you invested in March this year, or February rather, you would have seen some losses during March. But as you rightfully pointed out, if you had stayed in that investment vehicle, a lot of these funds are starting to recover and almost where they were in February. But for those clients who decided, okay, the risk has become too great, going into March, and they panic and they sold out, they would have actually just taken that on the chin, and they wouldn't have enjoyed that recovery as well. If they moved to, for example, cash, and all of a sudden the cash rate also drops, you would have seen that at the bank as the South African Reserve Bank cuts rates. It's almost this double impact. And, what happens while you're trying to save for retirement? It's really, there's this classic saying, it's time in the market, but not timing the market. So you really sometimes just have to calm yourself down. You have to say, listen, we have to trust who we have invested in. We understand this is a long-term investment. And if you have any concerns, then maybe reach out to a financial advisor or to an investment professional and seek their advice, but don't act spontaneously thinking that you're making a right decision, because in the long run, it can really do damage. And this is why it's so important to do your homework with regards to who you invest in. You look at their track record, you look at who the manager is, and you look at what suits you and what resonates with you and what has a long-term track record that you are comfortable with and that you really trust. It is really about building a trust and saying, okay, it's been a bad period, but I trust you. And in the next 10 years, everything's going to be fine. And that's difficult. It really is, because you're asking someone to have faith in you for the next 10 years. And, you know, that's ultimately what it boils down to. You just really have to build that trust and be patient. That's what it boils down to.
I always say, in terms of investing in a unit trust type of funds, you have that additional advantage of it is a fund manager who is a specialist, basically dealing with your asset allocations, and you do not really need to worry about, should I, bring down my equity exposure and up my cash and all those kind of things, because you are having access to a specialist, somebody like yourself who's doing this on a daily basis, and those people can make those decisions for you. So that is definitely, to me, another advantage of a unit trust type of fund, where you have that access to knowledge and a specialist kind of expertise.
No, absolutely, you are so correct. Ultimately, if you were to try and do this on your own, there would obviously also be other implications, which we're going to discuss later, I'm sure, with regards to tax, etc. So that's also another consideration. But with regards to what happens within that fund, we wake up, we're looking at the market. We have a whole team, and these various asset managers have teams of people looking at this on a daily basis, watching the market, making sure that the asset allocation, like you say, is correct, that the selection within that asset allocation is correct. This is what we live and breathe. So unless you are, you glued to your computer screen, watching everything and reading every day, it is going to be very difficult to kind of do that on your own. I'm sure people have done it successfully, but it also takes a lot of weight off your shoulders with regards to stress, because you know that you have a trusted team backing what is going on, and they can act accordingly with regards to, for example, a situation like March, where we don't panic, we don't do anything rash, we watch the market and we act accordingly. I think that is a very important thing.
Yeah, absolutely. And then we've touched now on retirement. Now, I know there's always different views in terms of reaching retirement age. Then a lot of people feel they want to become kind of less aggressive. They maybe want to move more into cash type of investments. There's again other views where people feel that the closer they get to retirement, the more aggressive they want to get, because they want to, try and get their retirement savings increased as much as possible. But maybe you should just give us a bit of clarification, kind of how you can use a balanced fund successfully within your retirement planning.
So that's a very interesting question. Like you rightfully say, there are various views with regards to how you should be managing your money pre-retirement to reach the goal that you want to achieve. I think the very important thing to know is that your expectation of, how much you want to retire with and what kind of lifestyle you want to lead once you have retired obviously dictates how you need to invest, building up to that. It is very important to discuss this with a professional, financial advisor, etc., who would be able to guide you in this this process, because ultimately what you want to be involved in is outcome-based investing. It's also very important to set the expectation correctly. Everyone wants to only save 100 Rand a year, but retire with 20 million Rand in 2 years. That's the dream, but it's just not something realistic. Mm-hmm. So, a balanced fund is a great vehicle, like I say, for a very long-term investment period. And ultimately, it should get you where you need to be. And it is, once again, one of the safer options all the way through until retirement age. But this is really something you need to discuss with a professional with regards to what must I save every month? What is a reasonable expectation with regards to the growth of that money? And what's a reasonable expectation once I retire with regards to how much access I have to that cash, or how much cash do I have access to, rather? Because even once you actually retire, that's a whole different aspect with regards to how you invest that money. What are the drawdowns, meaning how much of that capital can I use per month? And your various other aspects, which I think are probably beyond the scope of this discussion, with regards to, where do you want to end up within your retirement period? Do you want to leave money to your family when you pass away? Do you want to kind of break even at that point, et cetera, et cetera? So there are a lot of things to consider, and it's very individual. It's kind of a very difficult answer or question to answer, but a balanced fund is a very good vehicle, and I would argue all the way up until the point you retire, provided you had your getting tongue-tied, provided you had the correct expectations and that you had been diligently contributing to your retirement. Then you should be in a very good position using a balanced fund.
Okay. Yeah, and I think it's also on that point important for the viewers to notify that nothing that we are discussing here you should take up as financial advice. We want to give you some knowledge so that you can make better decisions yourself, and that you can have the knowledge to ask the right questions. So take whatever you are learning from this discussion and then talk to your financial advisor and ask them these questions. So use this as gaining knowledge for you to make better decisions in terms of your financial future. Now, Johan, we have mentioned a little bit about the underlying asset allocation, but maybe you should just explain to us, so what are the typical asset allocations? I mean, I understand that the percentages could vary. It will vary from asset manager to asset manager. But for example, say for instance, you invest or you currently have 60% in equities. What will make up most likely the remainder of the portfolio?
Okay, so before I answer that, let me just quickly give the viewers a reminder of the limitations of a balanced fund. What can we as portfolio managers invest in, and what are the limits? So with regards to equity, I did mention this right at the beginning, there's a 75% maximum exposure to equity, and that includes offshore equity as well. The offshore component can be a maximum of 30%, but then you've got another 10% which can be invested in Africa, but that excludes South Africa. Okay, so you almost have a 40% exposure, but 30% in ex-Africa. Okay, then you can also do a maximum of 25% within property, and that also includes international property. So property is almost seen as a separate asset class, even though it trades like equity. It's a very similar, or it is the same concept, really. Mm. So as you pointed out, there are various ways that you can invest. Every asset manager will have their own allocation strategy. And just to comment on your statement about, let's say 60% was invested in equity, then you have to consider, how much is offshore of that 60%. So you just can't obviously surpass that 30% allocation within that realm, and then obviously another 10% Africa ex SA. And then you can obviously add in some property, fixed income, and then also cash-like instruments you can access, money market, or you can put it on call accounts, etc. At the moment, I would argue that people will start ramping up their equity exposure as vaccines have come through. So you might see people starting to rotate from one asset class into another. Let's say you had quite a lot of cash going into this. You might want to say, okay, now I want to start adding a little bit of exposure to property. Maybe the fixed income space has done X and Y, so you maybe want to rotate into something different. So it's very difficult to give an overarching view of how you would typically invest. It is really down to the investor, the portfolio manager, sorry. But once again, touching on your earlier point, the beautiful thing about this balance fund construct is that we have the ability to move strategically and tactically as we see fit within this realm, based on those guidelines which I've mentioned, the 75%, 30%, etc.
Okay. So, but then you obviously confirm that through an investment in a balance fund, you can have exposure to offshore assets as well.
Yeah, absolutely. You can have access or exposure to offshore, provided it doesn't surpass that 30%. And there is some merit to it with regards to, once you invest in another country, let's say you're investing in American equity, it's great when the rand goes from 15 to 19. It's not so much fun when it goes from 19 to 15. So that limitation also just kind of helps take out the currency exposure. That is something we obviously very cognizant of, and that obviously adds to the volatility. And currency is notoriously difficult to predict. You are also able to hedge within these portfolios if it is within your mandate. So at Katie's, we do use some hedging strategy. And that's really just to take the edge off that FX volatility. But you are right, we have access to offshore. That is definitely something we use. And we actually think, because of the opportunity set abroad, it is a great way to diversify your portfolio and get access to sectors we don't really have within South Africa. So it is a great tool to actually leverage and use within a fund like this.
Okay, and then now, if somebody decides, okay, they want to get investing into a balanced fund, how can they typically start off, and is there like a minimum investment requirement?
So this is one of those things that also varies from manager to manager. I believe some of the managers you can approach directly and you can do it via their website, for example. But a typical way of accessing a variety of different funds is through what we call a LISP, or a linked investment service provider. They're essentially platforms which you access that has specific access to these various underlying managers. With regards to the minimum investment, that also varies depending on the route that you're taking. And I would highly encourage you to speak to a financial advisor to give you advice on, once again, how much should you be saving to get to that retirement that you have been dreaming of effectively. But you can do lump sums, and you can also do a monthly debit order where you have a specific amount that you contribute monthly. Once again, I cannot offer advice. This is just merely a statement, but to be consistent, it is usually better to set up some form of consistent contribution as opposed to, just a one-off and then hoping it grows. Once again, it's something you should discuss with your financial advisor, and obviously you need to consider all the fees that go with these various routes.
Yeah, absolutely. And then in terms of liquidity, Is it fairly easy to invest and disinvest?
It is, but there are a few aspects just to consider. So these funds are priced daily. You can see what their price is, and if you decide that you want to disinvest, there is liquidity available, and it's typically, I think, 3 to 5 days before that money is actually available. However, because this is predominantly used for pre-retirement money, there are various tax implications with regards to how you access that cash. So, for example, if you were invested in one of these funds, for example, and now you actually want to use the cash for personal use, you want to buy a house or a car, whatever the situation is, you just need to be aware, depending on your personal situation, there could be tax implications trying to access that cash. But if, for example, you were switching from one balance fund to another balance fund, meaning that you are still staying within the realm of saving for retirement, then the liquidity is not an issue, and there will obviously be no tax implications, provided that is within your, what shall we say, that you're following all the protocols to not trigger any tax event. So our funds are very liquid. If people make withdrawals, there's always cash available, and yeah, these instruments are very liquid.
Okay, now, and then we obviously now have different underlying asset classes in terms of equities, paying dividends. We have some fixed income with interest. We have some properties with some rental income. So maybe you should just explain what kind of returns can the investors expect from investing in a balanced fund?
Okay, so that's a good question. And with regards to benchmarks, let's just quickly start by just elaborating a little bit on that. Balanced funds predominantly have an inflation plus target. At Katie's, we are looking at about inflation plus 4%. And this is what we refer to as an absolute benchmark, because it's not relative to anything, versus a relative benchmark where it's, for example, the JSE, where, you know, the JSE's done 10%, and if you've done 12%, you've outperformed the JSE, and that's well done. With the absolute benchmark, ultimately what we are trying to do is just get that benchmark, taking the least amount of risk. So even though we are targeting inflation plus 4%, it does not necessarily guarantee that you're going to get that. It also doesn't guarantee that you're going to get less than that. And the reason I say this is because of the construct of these funds. If every asset class is, for example, providing zero, it's going to be impossible to target, you know, CPI. Let's just say at the moment, you know, it's 3.2, call it 3.5 just to make things simple. Add your 4%, you're looking at 7.5%. If none of your asset classes are delivering that, and your selection doesn't allow you to do that, you're not going to hit that target. But this is why it is so important to invest for the long term. Over the longer period of time, you should be getting that inflation plus 4%. And once again, the reason it's such a specific benchmark is because you want to protect your capital for retirement. You know, if I buy a loaf of bread today, it's obviously going to go up inflation over the next 20 years. So when I buy bread in 20 years' time, it's going to be impacted by that inflation. So you at least want to preserve your capital, but also you want to grow your capital. And that's why we have that spread, that plus 4%. So we not only preserve your capital, but we also grow it over time.
Okay, and then in terms of the factors that can impact on a balanced fund, what are the typical things that you would consider?
Sure, that's a loaded question. So, you know, at Katie's, we follow a top-down, bottom-up strategy, and ultimately what that means is we look at a macro view, and what we mean by macro is we look at all these outside influences that affect the economy, not just within South Africa, but externally, abroad, etc. Because South Africa specifically, it's a very small economy within the global scale. So you will often see news coming out of America and it'll impact South Africa, for example. So what we specifically look at, or these factors that we look at, is literally anything we deem could have an impact on the performance of our funds in the longer term. So it's very important to understand that we will never have a knee-jerk reaction to short-term information. And this is another key point with regards to why you want someone looking at your portfolios day in and day out as a job, because we have to sift through a lot of data, a lot of these factors, and we have to decide which ones are relevant, which ones are actually going to be driving returns of these various asset classes over the next 3, 5, 7, 10, 15-year timeframes, and positioning the portfolio accordingly. So I know it's not an exact answer with regards to what factors we look at, but because it is such a broad range and it is always changing, it is very difficult to kind of pinpoint. But it is definitely the macro factors, the global factors, what's happening with our economy, what's GDP growth doing, what is the government doing, etc. And then, as you rightfully pointed out, that kind of guides the asset allocation, but it's also important to look at what are the drivers of the various businesses. So, for example, if you look at tourism stocks going into March, obviously, if travel gets shut down, then airlines aren't going to do well, for example. So we have to take that into account. Even though we've never been through a pandemic in our lifetime, it is all of a sudden a new factor that we need to consider, and we have to act accordingly. So there's such a vast range of factors, and they are ever changing. And like I say, that is why you want a professional in your corner to kind of help you and guide you and really just take that stress off your shoulders so that you can sleep easy at night.
Absolutely. But I think obviously saying that, then that is also attached to some costs and some fees involved. So maybe you can just touch on that, kind of like, what are the typical costs and fees that would be involved?
Okay, so at the most granular level, you're looking at a management fee, and that's literally the fee that is charged by the asset management company to manage that specific portfolio. So that's really the most basic thing that you're paying for. Then you also need to consider that the fund itself has costs involved with it as well, the admin fees, etc. That obviously runs through the costing of the fund, and then also the transaction costs of the fund. So when there are transactions, that obviously also impacts that number. So that is encapsulated within what's called a total investment charge, and that you will see on a fund fact sheet, and that's the first kind of impact that you will have on your performance. So when you look at performance numbers, you will look at your performance after those fees. Okay, that would also include performance fees if they are attached to a fund. So, for example, if there'll be a clause that a percentage of the outperformance above this fund's benchmark will be charged as a performance fee, that would also be included in that TIC, total investment charge. And like I say, that would be deducted from the performance. So when you look at how a fund has performed, if it's done 10%, that 10% is actually what it's done after its fees. So it's always net of fees. But that's only specifically for a fund. Now you also need to consider, have you contacted a financial advisor? Is this financial advisor asking for a fee? Am I going via a linked investment service provider or a list? What is their platform fee, etc.? So there are various fees that you do need to consider. And, as you pointed out, we're not giving advice. It is very important for you to actually seek professional advice from a financial advisor who can guide you on this, so that you can you obviously want to pay a reasonable fee for a reasonable outcome. So fees have become increasingly important, and I would highly encourage the viewers to go and seek professional advice so that they understand the fees they're paying for and they're getting value for money. You don't want to be paying excess fees eating away at your returns so that you're not actually achieving your goals.
Mm-hmm. And I think with that, it's also important that the viewers understand to basically compare apples with apples. You know, sometimes people would quote a performance, whatever, but that could be like in before fees have been deducted or after fees, and that they just always make sure that they are kind of like in comparing similar things and not kind of, you know, afterwards get a surprise to see, okay, but now my fund is not performing as I expected it to be because of the fees, and I wasn't aware of what's actually happening with the fees. But because of that kind of impact that can sometimes be a surprise, taxes could also sometimes be a surprise to people. And I know this is also a very wide question because it will differ from person to person, but maybe you can also just touch on the tax implications.
Yeah, sure. So once again, we mentioned this very briefly earlier, but if you were to kind of construct from, you know, building blocks, meaning that you invested in assets yourself, meaning you bought X, Y, and Z equity and this fixed income, etc., then you are subject to tax. You will be taxed as an individual. However, within the construct of a balanced fund, whatever we do within this fund is tax exempt. So for example, if we sell something for a profit, we're not taxed on that. So that, excuse me, is a huge benefit to using a balanced fund or a collective investment scheme in general. So that takes part, or that takes care of the discussion with regards to what happens within a fund. Now, the other thing you need to ask yourself is, am I using this for retirement? Is this a retirement annuity, etc.? Is it post-retirement? What am I trying to achieve from this vehicle? And if, for example, it is, and I'm speaking very broadly, if it is pre-retirement and you are saving for your retirement and you're making these contributions, then there might be applicable tax breaks from the government. And if it is post-retirement and you're trying to do something, there are various other tax implications. So unfortunately, this is something very specific to the individual, how they're using the fund and how they are not only accessing the fund, but also how they are withdrawing from the fund, etc. It's very important to seek professional advice, because obviously you can construct your affairs so that you pay the least amount of tax which is applicable to you. Because if you're not aware of these tax consequences, you could very easily be saving for retirement and you say, listen, I used this example earlier, I want to buy a house, and you take all your money out if you had access to it, and all of a sudden you get a huge tax bill that you weren't expecting. So it is very important to seek professional advice, and it is really person to person based on their circumstances.
Okay, and then for people who are comfortable making investment decisions themselves, they have the knowledge, they do their homework, there are options where they can invest directly, and it's not that they have to invest through a financial advisor.
No, that's true. They can, once again, they can approach specific asset managers where you can go onto their website and you can invest directly, or you can access a LISP, for example. So if you do have the skills and you are competent and you're comfortable doing it, it's not that you need to seek the advice of a financial advisor. You do have access to these various platforms where you can actually structure it yourself. I would just caution that, sometimes we maybe are a bit overconfident in our abilities. And I'm not saying that is the case for your viewers or someone who wants to take this on their own. There are many competent people out there, but just make sure that you really do your homework and that you really follow every aspect of what you are trying to achieve, because like we say, there are tax implications. There are various implications for things further down the road, and you don't want to get to retirement age and get a little surprise. And that's actually a scary thing that we often see. You know, people are saving for 20, 30, 40, 50 years, and then all of a sudden they get to retirement age and they go, this is really not what I was expecting. So it's very important to start saving really early, understand what it is you're trying to achieve, and really do your homework. And like you say, if you're competent and you're comfortable, you are welcome to pursue that. That is an option.
Yeah, no, I totally agree with you. I think it is so important that you do educate yourself about finances, whether you are making decisions yourself, whether you are getting experts in to assist you. It is important that you have the knowledge to ask the right questions at the right times. But Johan, I want to end off with a last question, and this is I think more maybe a personal question. As a fund manager or a portfolio manager, how did you experience this whole lockdown scenario? Because this must actually be, quite difficult, because for all of us, it was something completely new, completely strange. And for you guys, where you do a lot of, analysis, looking at history, looking at data, and now this kind of complete unknown pandemic sits on your kind of like is right there, and now you need to react and try to still get the best performance under the circumstances. So how did you experience all of this?
So first and foremost, I think what's important to understand is we're very fortunate within the financial industry that we are very capable of working from home without too much hassle. So that was obviously a huge plus just from a personal side, the fact that we could still communicate. We still had access to everything we needed access to. We still had access to, all the data providers that we required to keep track of what is going on within the world and specifically within our funds. But, if you're referring to specifically managing money during this period of time, it's so easy to be reactionary and make drastic decisions that can ultimately hurt the outcome that you're trying to achieve. And it was incredibly stressful, obviously, when a lot of these assets, there was no real place to hide. As this happened, a lot of the assets started selling off, and you had to think really carefully. Is this something you now want to say, okay, this is something that's going to carry on for the next 5 years? Are asset prices going to be depressed for the next 5 years? Should I be selling? There were the very difficult discussions that we had within the team. And I'm very pleased that we were very slow to react with regards to making any drastic changes within our portfolios. We really try to consider every outcome or every scenario that could eventually play out. And, you're not going to get everything right. Very few managers are going to get everything right, and not everyone's going to get everything right all the time. It's really impossible. But we ask ourselves the question, is this a temporary thing or is this a longer term thing? And in the grander scheme of things, with regards to, if you think 5-10 years out, this is an unfortunate, drastic dip within the market, and we saw it as such. So going into this, we already felt that some assets were a bit stretched in valuations. So we had quite a large cash buffer, and that played out very well for us going into COVID. And that's not because we knew COVID was coming. I wouldn't be naive enough to say that we got caught off guard, I think, like a lot of people did. But what happened is, as things started degressing, excuse me, we didn't sell any assets. we actually started deploying some capital going into March and April. And that has stood us in good stead. And this is why we keep on emphasizing you need someone to really keep an eye on your money day in and day out, and really focus on that with a team of professionals where they can really make informed decisions, so that you don't act drastically and do anything that could potentially hurt your retirement or your savings goals in the longer term. So long story short, it's been tough for everyone. I'm sure all the viewers have experienced some or other discomfort with regards to, moving around or visiting friends, or, people getting sick, etc. But, we're very fortunate in South Africa. We're quite a resilient people, and I think we've dealt with it quite well as a nation. And luckily, we've got good leadership in Cyril. So it's been a tough time, but we keep on fighting.
Okay. Great. Johan, I want to thank you for joining us today. Thank you so much for making time and sharing your knowledge and wisdom with the viewers. We really do appreciate it. And yeah, I also want to wish you well. I think you've been through the worst, and it can only pick up from now. But then also to the viewers, thanks a lot for joining us. I really hope it helped you and you gained some more knowledge and a better understanding of balanced funds. If you are already invested in it, you have more knowledge to go and analyze your funds and analyze your portfolio. And also, if you are maybe not yet invested in something like this, for you to consider if it could be something that you want to add to your portfolio. Once again, remember, this is not financial advice, so please take the knowledge, what you have learned today, and go and talk to the experts and let people help you to make the best financial decisions for your personal financial well-being. So I want to again say, please subscribe to the channel, enter the giveaway competition where you can win one of the Financially Fit and Wealthy books. And I want to thank you for joining us until the next Ronel Talks Money Show.